So we start chapter 9, and in chapter 9, we start building our pro forma out. We're going to uncover the building blocks for our discounted cash flow analysis to try to get some answers on profitability, rate of return, both leveraged and unleveraged returns. So the return to the property as a whole, and the return if there's debt on the property, and the return simply to the investor. We're answer those sorts of questions, explore some different indices and different measures. We're going to start with the relationship between the cap rate and the discount rate. If you remember right, the cap rate is the R in that relationship, V equals NOI over R. And then we move into the discount rate, which is the rate at which we discount the cash flows over our holding period. So if we're going to hold the place for 5 years, then we're going to discount it accordingly. That's where we're headed. So right now, again, we're going to start with this relationship between cap rates and discount rates. And of course, one of the things about the cap rate that you want to keep in mind, and we've talked about this before, is that it only has reference to the next year, to a single year. And of course, we own properties typically for longer than a year, but it's utilized extensively as a basis, especially when we anticipate cash flows to look reasonably similar into the future of our ownership. I thought before we would get to that, I would show you this back of the napkin tool that a lot of folks out there in the world use. They're called income multipliers, and they typically come in two flavors, PGIM or EGIM, and the P stands for potential gross, and the E stands for effective gross. So in our pro forma, the first line is potential gross income. Then we take vacancy and collection out, and we're left with effective gross income. And we're going to utilize those measures as a way of estimating a first line number for what we might be willing to pay for an investment property. And I'll do that via an example, show you how we would actually employ them. So in this fictitious neighborhood, I have identified a property that I'm interested in buying, and I've done my research, and I've projected the following information. So the subject's right over here. I've projected for next year that the potential gross income, is $130,000. I'll take a nice conservative estimate on vacancy and collection and say that it's 10%. And so that's going to leave for the EGI the 117. I've identified 3 comparable properties that sold in the market. Okay, we refer to it a lot of times in real estate as the neighborhood. And the neighborhood's depends on your experience. A lot of times people think of the neighborhood as this blocked out area with cul-de-sacs and so forth where houses look reasonably similar. And that works in a housing market, but if you're thinking about, for example, hospitals, the neighborhood may be the entire Great Lakes region or the entire Mid-Atlantic. Trucking centers, the same kind of thing, all along the 95 corridor. So I'm going to say, just for the sake of our arguments, that we're looking at a multifamily property, and let's say it's somewhere near VCU. So I found 3 other properties in the vicinity of VCU that are multifamily or rentals for students, and this is the information that we gathered on those. So the potential gross income is listed here, 150, 125, 100. And this would be at the time that they actually sold, okay? So these sales could be a couple years old, and this is what the income was for the year after it sold. Here's our vacancy and collection issue that they dealt with, and so then we're left with EGI. All right. We have operating expenses for each of those, and it's estimated at 35% of the total EGI. Okay? So basically what I'm doing is I'm doing our little pro forma that we saw in the learning glass, trying to get to NOI. So then the other thing that I need to incorporate is this CapEx. And the CapEx, again, as you remember, is that amount that we need to take off of our operating income in order to ensure that the place doesn't accelerate in terms of depreciation, right? So we're saving money for large capital expenditures. We're putting it away in a safe investment. And that way when it comes up, we'll be ready to pay for it. And that will give us this economic NOI. Without the expenditures in the CapEx column, our property will depreciate at a faster rate and it will lose its value by virtue of its inability to generate revenue. So in representing a true measure of economic NOI, it's important that we extract a value that we referred to when we did the time value of money practice as a sinking fund. You might recall, or you may need to go back and look at it again. There is an example at the very beginning of the semester where I illustrate a shopping center that's going to have a facelift. You were asked to find out how much money you'd have to put away on a periodic basis in order to have sufficient amount to invest in that facelift in, I believe, about 7 years. And that's exactly what this represents here, that capital cost that's above and beyond the normal operations of the building. So once we take those out of this EGI, we're left with these three values for NOI for our comparable properties. And this is what they sold for when I observed this information. And so what I end up with then is a multiple of their potential gross income. So this sale price and this potential gross income represents that multiple of 7.13. So this 1,068,750 is 7.13 times the 150. Likewise, 675 for number 2 and 690 for number 3. Another one then, of course, would be the EGI. And as you can see, we have a slightly different number, and they're all the same on that one, 7.5. So again, this 843,000 is 7.5 times this estimate of EGI for comparable number 2. Now what I've just done over here, just to illustrate how we might use these, is I've taken the average of the two, and then I've looked at my subject. And so here's my subject. Last year's or next year's PGI, depending on how you look at it, is projected to be $130,000. We're going to anticipate a vacancy and collection of 10%. Then that leaves us with an effective gross income of $117,000. If I apply the average of those multipliers that we've obtained from the comparables to these two estimates here for next year, we end up with these two values here. And they represent, like I said, a back of the napkin estimate of what we might be willing to pay for the property. Obviously it's going to require more research, but on a front end quick analysis, it gives you some information on which to base your decisions. And so that's the potential gross income multiplier and the effective gross income multiplier. Like the cap rate, as you saw from that illustration right there, it considers only next year's information. We're not casting forward into the whole holding period. To get into that, we need to think about the internal rate of return. And the internal rate of return is specifically projected to capture all those expected changes in income over time, expenses that we may have knowledge that are going to change, vacancies that we might be able to project into the future. An example of this might be a property that has a number of leases, say, that are going to come due in 3 years, and you and I aren't planning to sell it for 5 years. Well, if the rental market happens to be falling during this period of time, and at the end of 3 years, the leases that we have on the property are in excess of market, we can expect to see those tenants either leave or renegotiate for a lower term in order for us to be able to retain them. And so those kinds of things need to be incorporated into our projections. And in doing so, we're going to project out multiple years and utilize that IRR as an estimate of what our return will be for the property. This is just a rehash of what I've already said in a different frame in terms of the cap rate. So looking at the second bullet, this is my V. There's NOI over R, and I'll ask you to keep in mind, NOI is always 1 year forward of our projected V. So as an example, if I'm trying to figure out what the value is today, I would have V, say, sub 0, and then NOI 1. So I'm projecting forward. And just to move the terms around a little bit, this is how we estimate the cap rate by NOI over the sales price. And again, as I've said already in the prelude with the prior slide, it's useful for vacancy and expenses for next year and the cash flow for next year, but it doesn't tell us anything about how NOI may change going forward. Although the cap rate has its limitations that I've mentioned, it is extremely useful because, one, it is readily available in the market. Sources like Real Capital Analytics and CoStar frequently publish cap rate estimates. Likewise, if we want to figure out what the discount rate is for properties, i.e. the rate at which we're going to discount the cash flows throughout the period of ownership based on components of risk and location and so forth, that is a more elusive estimate to obtain, and we can use the cap rate because of the interrelationship between cap rates and discount rates to find an estimate of that discount rate. So I'll show you two quick, relatively straightforward examples on how to do that. First one's referred to as the risk premium model, and those of you that have had basic finance classes will be familiar with it. And then the cap rate model. The risk premium model, again, looks just like what many of you would have seen in your elementary finance classes. We're going to start with a risk-free rate, R sub RF, and we're going to add a risk premium to that to figure out what the discount rate is to the entire property, this R sub P. Okay? We can start with, for the risk-free rate, our risk-free returns from U.S. Treasuries. I have two illustrated here from recent times. The 1-year T-bill and the 10-year Treasury. If I'm doing this, I will typically look at the long-term rate. So in this example, I would refer to the 10-year Treasury because I'm going to own this property for a lot longer than 1 year, and I want to reflect the influence that that time has on the risk-free rate. So as you can see, it's 20 basis points higher, and of course we're in a low interest rate world right now. Sometimes that spread is dramatically larger, and it's even more important that we reflect the reality that we own this property for longer than just a single year. On average, institutional grade investment properties have seen a risk premium of about 350 bips or 3.5%. And again, I'm going to restate that. It's institutional grade investment properties. So folks like Heitman and TIA, CREF that purchase properties just basically to clip coupons because they're rented to, Class A top shelf tenants with strong lease records and things of that nature. Recognizing a relatively low risk property, the risk premium is small at 350 bips. Again, the kind of properties that maybe you would be interested in investing, assuming that's one of the things that you're considering or pursuing as you think about taking this class, your risk premium would be substantially higher. Well, anyway, we're going to add the 2 and the 1.8 to the 3.5, and I end up with some kind of a range for my discount rate at 5.3 to 5.5. And that's a relatively low estimate right now. And again, reiterating, it's because we're in such a low interest rate world. That's the risk premium model. The cap rate model says that we can incorporate that cap rate, which is the first year's multiple or divisor, the denominator that goes in that value estimate. And we're going to add to that or incorporate the NOI growth that we expect to see over time, if there is such a growth. Right, so think about it. Remember what the limitations are of the cap rate. Cap rate only looks at year one information. So by incorporating this, I'm basically saying, all right, so what's the difference between year one and say year 2 through 5 when I finally decide that I'm planning to sell this thing in year 5? Well, NOI growth is a function of, for lack of a better set of information, inflation, and then this CapEx or depreciation. So I'm going to recognize the reality of inflation, and I'm going to adjust it for CapEx. And that's, again, to maintain that growth potential in NOI. Without the capital expenditures, I won't have it, of course. There's some prior research by academics that says that CapEx typically runs around 1 to 2% of the building value over the long run. So that gives us something to base our estimates on. And I'll just throw that in there as a base number, okay? So in this little example that I have here, current market says that cap rates are around 7%. We're looking at a 2.5% expected inflation year over year, and the capital expenditures, as I said, are going to run around 1.5%. So just incorporating that information, I have the 7%, I'm going to take the NOI growth and adjust it for CapEx. The NOI growth is based on our estimate of inflation for now. And I end up with a discount rate of 8% on a cap rate of 7%. A little hint or a note, the discount rate is typically always larger than the cap rate. And again, keep in mind, this is an institutional grade kind of an estimate. You would typically see a premium of about 150 to 300 more basis points on investments that are of less caliber. Okay. The next few slides are just some samples of those cap rates that I'm referring to. This is from Real Capital Analytics. The CEO's name is Bob White or Robert White. They have, over the years, collected data on sales of real estate transactions in excess of 2.5 million. And you can see the flow in cap rates over time. Look, remember, there's a relationship between cap rates, interest rates, and discount rates, of course. Since interest rates are closely tied to discount rates, that's the rate of return. You can see that over time, heading into that financial crisis at 2007, those cap rates were systematically and consistently falling for all these property types. Note these collars in case you can't see it real well. Each one of them represents a different property type that's in their database. Green, of course, being apartment buildings, generally tend to run relatively low compared to the other properties, simply because it's a fairly consistent sort of an investment, as it represents housing for the population, and so the population typically continues to need it even in a recessionary period. Notice the big jump in cap rates during the recession and the financial crisis, as properties or real estate investments in general became less attractive. Of course, keep in mind, this cap rate is that R that's in the denominator. So when I raise that R, I'm basically lowering the value estimate. So during this period of time, of course, there was a dramatic decrease in real estate values. And that occurred even when there was not a precipitous increase in vacancies, simply because of the increased perception of risk in real estate investments that drove these cap rates up and thereby created a lower valued market. And again, I'll go through them kind of quickly. I just grabbed another source. This is the Real Estate Research Council. Same sort of precipitous fall and a large rise. The reason why I included this one is because it has a larger pool of observations beyond. So a lot of properties, for example, that are lower than the 2.5 million floor that Real Cap Analytics requires. Same sort of a general illustration, though. And this is RCA with casting into the current period of time. So we're out through 2018, and we also see superimposed on here 10-year treasuries. And as you can see, there's a relatively large spread through most of the period of time for 10-year treasuries to other real estate investments. And what's important to observe, at least in my opinion, on this particular slide, is how tight that spread became right here during the prelim or the precursor to the financial crisis. It gives you a little hint that cap rates for real estate were getting too low. Something to watch for as we go forward. If these cap rates continue to fall and possibly 10 years continue to go up, that spread gets tighter and tighter, you may see a similar result in the market. Sometimes it's important to be able to take the cap rate and or the discount rate and segment it. In the case of a parcel of real estate, we basically, in short, have two primary interests: equity and debt. Debt, of course, for the moment, we'll say, has a fixed rate of return, right? Whatever they're charging us for our mortgage. Equity, on the other side of the equation, has a different rate of return. We can take, again, those discount rates and cap rates and segment them based on the different interests in the property. So, and that's what I'm doing here with this particular slide. So this simple equation represents the return to the property. And that return to the property is a function of the return to debt which is R sub D multiplied by the loan to value ratio, or LTV, plus the return to equity, which of course is RE times the residual of the LTV. So if we're borrowing, say, 75% of the purchase price, then it's RE times 25% of the value of the house, or the real estate, excuse me. We can likewise do a little rearranging with the terms and find out what the return is, and a cap rate, what the return is for equity and the return for debt in this format. You might have another interest in doing that simply because you have different interests in the real estate. So consider a lot of the metropolitan cities or metropolitan buildings in central business districts. It turns out an awful lot of those buildings sit on 99-year leases. 99-year leases that someone else owns. So for example, last I knew, the number could have changed, but the last I knew, 1,200 very premium parcels in Manhattan were owned by the Trinity Church. They were granted to Trinity by the king when Manhattan was invaded and the Indians were run out way back at the beginning of settling of the state of New York. Trinity, fills its coffers by charging rent on these buildings with these long leases that are, quite substantial leases. Under those circumstances, the return to the building and the return to the land are completely different. Not only that, it might also be interesting, even if they're not in different ownerships, to consider what those returns are, simply because of the reality that we assume in the real estate world that land does not depreciate. But of course, buildings do. So let's go through a little example of segmenting this cap rate in this example. And I'm going to segment it by land and building. And this is from a legitimate example that I had to do, 8 years ago or so. I had to value campus facilities for the University of Cincinnati. University of Cincinnati is very similar to VCU in that it's located in a major metropolitan area. It has a medical campus and what I'll call a social science campus. And I was asked to do all the medical facilities. And in that space, a lot of the buildings in there were on land that was leased. And so that's where this example came from. Let's look at it together. So there's a new building being finished, and it has a value of $20 million. And it sits on a ground lease, as you can see. The land is going to be leased for $200,000 per year, and it's estimated to be worth about $4 million. When this building is finished and opened, it's expected to generate NOI, or net operating income, of $1.6 million over the coming year. So with that information, let's try to figure out what the cap rates are for the land and the building, and then the overall cap rate for the property in general. So we go to the second worksheet in the Chapter 9 packet. So what information did we have? So the facility is going to rent when it's leased up and when it's fully built for $1.6 million. We already know what the land generates in income. It's $200,000 a year because that's what the developer is paying the owner of the dirt for the privilege of building the building. So if I just take that land income out, this is the amount of the total income that I can attribute to the building. Based on what we were given for information, it's going to cost $20 million. We're assuming the cost and value are the same in this example. That's $20 million in total. The land value was given to us based on, we'll say, an appraisal at $4 million. So the value to the building, the residual then, is the $16 million. Well, some really straightforward math. Doing my NOI over value to find the cap rate. So the NOI is 1.6 for the property. The total property value is at $20 million. I end up with a cap rate of 8%. And of course, there they are pieced out. There's the land, 200 over 4 million. There's the building, 1.4 over 16 million. And so I end up with a cap rate of 5% for the building, or for the land, and a cap rate of 8.75% for the building. for those of you that are familiar with it, this can be handled a bit like the weighted average cost of capital. So this property rate is just a blended rate of these two. Up here, what I did was I estimated what the proportion was of total value that could be allocated to land and building. And of course it's 20 for the 4 million and 80% for the 16 million. The blended rate then will incorporate that 20 and 80 and this 5% and 8.75% in this little illustration here. So the building comprises 80% of the value, and the cap rate for the building is 8.75%. Likewise, 20% to the land and 5% for the cap rate. Add those two together and you get the value for the cap rate for the entire property at 8%. Okay, let's move beyond cap rates and start talking about the measure that is ubiquitous in the real estate industry, the one that everyone seems to pay an awful lot of attention to. And that's the IRR, the internal rate of return, or the yield rate. And as I explained earlier, it accounts for things that change over the course of ownership, like vacancy, operating expenses, the potential for growth in income, and at the end of the day, when we sell this, changes in the value based on our original purchase price. As you can see there, I put the formal definition on the bottom of the slide, and it's kind of important to recognize that definition. It says it's the annualized effective compounded return rate, or what I'll refer to most of the time as the discount rate, that makes the net present value of all the cash flows, both positive and negative, from a particular investment equal to zero. So for the time being, let's just think in terms of we pay for the property at time zero, so that's an outlay. And then for the moment, for an example, we own this place for 5 years, and at the end of 5 years we sell it. And each year we have some positive cash flow for the 5 years of operating, and then on the 5th year when we sell it. All of those cash inflows are discounted so that they exactly equal that initial outflow that we made at time zero. And that's basically what this definition is telling us. And it's important to keep that definition in mind here in a little bit, as we'll kind of delve into some of the items or issues that you want to keep in mind when you think about IRR. Even though it's relied on extensively, it has some limitations or some caveats, and I think that everyone should be aware of them. So let's go through a little example, how calculating it and utilizing it and gaining some information. As you can see, we're going to go back to our Excel spreadsheets a little bit. I have an apartment building that's currently valued at 1.5 mil. It's going to generate 100,000 in NOI next year, and NOI is expected to grow at 3% per year thereafter. We're planning to hold this for 5 years, and at the end of the time, we believe, or we have an estimate of the sale price at 1,770. So I want to know what the IRR is, but I've also asked for a couple of other items, and that's the cap rate. It says going in, and I'll get into that in just a second. The NPV, or the net present value of the project, and we're going to determine that on an 8% discount rate. Okay, and then we're just extending it a little bit and say, well, what happens to this, to these numbers, if growth in NOI is actually negative, right? It's minus 8%. Of course, if the NOI is falling at 8%, I can't imagine that we're going to have this increase in value in the property like I have in the original estimate of 1,770. So for the time being, I'm just going to say that it's going to sell for exactly what we paid for it. Okay, well, let's see what happens. Lines 1 through 9 represent our first scenario, and then the 8% is in the second scenario beginning on 13. So I've got 3% growth. For the most part, this is the way you're going to see my cash flow tables run out. So I'm going to start with the first column at time 0 with our outlays, and then I'm going to go through each year of our holding period. This is going to be consistent through most all of our Excel illustrations. For whatever it's worth, over the years, it's made it easy for me to keep things organized and orderly. So as you recall, we have an initial NOI of $100,000, and it's growing at 3%. So I'm referencing to that 3% sell to grow it. Year 2, 103, and then finally in year 5, 112.5. So the cash flows then from operations are in this line here, and I carry them down here into this line. And the reason why I do that is because I have one additional cash flow at the end of year 5, which includes selling the place. And the selling price was estimated again at the 1770. So our actual cash flows from operations and selling are right here on line 5. Okay. I want to know what the internal rate of return is, or the yield rate, or the IRR, or the discount rate that makes all of these exactly equal 1.5 million. And I use the formulas for the IRR. Keep in mind, and this is the reason why I have NPV, note inside the formula cell here that I highlight from D all the way across, so it includes the inflows and the outflows to determine what this IRR is. That'll become clear here in just a minute. As you can see, it's right around 10%. This cap rate represents the relationship between the first year's inflows, or the first year NOI, and our time zero outlay for the property. So there's the D2 reference, and there's the E3 reference right there. I referred to this in the slide as the going in cap rate, and because that's what it's supposed to mean is exactly what it says, and that's what the cap rate is as we enter this investment. In a little bit, I will illustrate to you what the going out cap rate is, which is that cap rate that we use to estimate the selling price at the end of our holding period. In this case, it's given to us at 1770. Later on, you and I will estimate it with a going out cap rate. Lastly, on this illustration, we're going to determine or estimate the net present value of this project. That's right here. Recall that the discount rate that we're applying is 8%. A note on utilizing the formulas in Excel if you haven't done it this way before with the NPV. So right up there is the E9, that's the 8%. Notice that for the cells that we're referring to, it starts at E, not like the IRR did, and begins at D. The reason why that is because the NPV calculates the cash inflows over the course of the holding period. If you were to include this one, what happens is Excel will discount this as though it's going to be paid out a year from now. So it'll actually be less than 1.5. Likewise, year 1 will be discounted as though it's received 2 years from now, and so on. And so the number won't be accurate. And so what we have to do is we take all of the inflows, the year beginning in year 1 till the end of our holding period. In this case, it's in I5. And then on the outside of the paren, we incorporate that initial outlay of the 1.5 mil. And you can see the NPV is 126.6 or 127 rounded. It's positive. So on the basis of an NPV decision, we should accept this project. I will tell you in case you haven't played with these kinds of numbers, these sorts of numbers in a long time or at all. The very fact that the IRR is greater than the discount rate would cue you in right away that the likelihood that the NPV is going to be positive. That's a pretty quick hint. All right, let's press on. I said let's take a look at what happens to the IRR if annual growth is actually reduced, or a reduction of 8% per year. So here they are. Obviously, the second year it's going to go down 8,000, and subsequently we have a reduction of 8%. We're leaving this resale value at 1.5, and in reality it's probably actually lower, but it's okay, it's just for illustration. I'm going to sum these up just like I did above, and I'm going to estimate what the IRR is with those new numbers, and as you can see, it went down significantly. It's nearly cut in half, and that makes sense, of course, simply because of the reality of the returns. The cap rate, of course, however, doesn't change. It doesn't change at all. And the reason why it doesn't change is because it's a function of these first two periods, the period 0, 1.5 outlay, and the period 1, 100,000 NOI. So let's take a look at the NPV under this new scenario, the minus 8% annual growth. Well, as expected, it's gone down, and it's gone down significantly from 127 to minus 135. Same principle holds. We're going to incorporate these numbers, these values in our estimate, E17 through I17. I still retain the 8% discount rate, and then I add in the time zero outlay on the outside of the parens. And again, just extending my little observation, since the IRR is less than the discount rate, you can anticipate right up front that the NPV is going to be zero. So the cap rate stays the same, even though these projects look dramatically different on the back end because of the annual growth projections for our rent. This gives you a clue why the cap rate has its limitations. Let's take a look at some of the limitations on IRR, just to make sure we're clear on it. Especially because as you pursue real estate interests, you will rely on it extensively. So here's a few that have come to mind that I've included in my discussions on many cases. I'm going to start from the bottom, if you don't mind. It says uneven cash flows. Uneven cash flows means that there's a negative cash flow at some period during the holding period. So let's take a look at our retail space that I referred to in previous discussions. In 3 or 4 years, we'll say, it needs a major facelift. And utilizing that time value of money example, let's assume it's $7 million, okay? If our NOI is, say, 6, and we're going to do that in 3 years, so our net cash flow that year, because of those outlays, is going to be minus $1 million. So we're going to have a minus sign at time 0 when we make the purchase. We're going to have a positive inflow on year 1 and year 2, and I'll assume year 4 and 5. And I'm going to have a minus outflow in year 3 under that scenario. IRR, because of the nature of how it's calculated a bit like the derivatives from way back in your calculus class, where we're going to try to find the limit and the absolute max and min. In this case, trying to find the max is difficult because there are 2 different humps due to that negative cash flow that's created in year 3. And so you end up with multiple IRRs. Sometimes Excel will report the wrong one, or one that's dramatically different than what reality would be. And so whenever you have uneven cash flows, it's not possible to utilize IRR to get a good read on it, okay? There are times, back up to the top now, when you may have 2 different projects that you're comparing. One has a better IRR than the other, but that second project with the low IRR actually has a higher NPV. Well, since the NPV is what actually increases investors' wealth, you would probably take that project over the one with the higher IRR. So, IRR has limitations when you're comparing mutually exclusive projects. That's what that amounts to. The next one, it says IRR overstates the annual equivalent rate of return for a project. And here's the reason why. The main reason why is this. If you're a real estate investor, of course you're in a relatively illiquid world. And by virtue of that illiquidity, you're going to have to focus and invest your resources in what you feel to be the best project possible, the project with the highest return. And of course, you're going to receive cash flows on an annual basis on that project. And what are you going to do with them? Well, unless they're profound, unless it's a really, really big project, you're going to have to put it away and reinvest it and wait until you build up funds to go buy another deal. And so when you're doing that, you're probably going to put it in a relatively safe space. It's not going to be in another real estate project because you're waiting to generate enough cash flow savings in order to have that deposit on the next project. And you also don't want to sustain a loss because your business is real estate. So your investments with that cash are probably relatively conservative. IRR assumes that all of the cash inflows are reinvested at the same rate. And so in essence, in that regard, I assert that it actually overstates your legitimate return on the project because of the reality that those inflows are going into another vehicle, another instrument and waiting deployment into another real estate project that, of course, you will analyze and do your research and find the very best one with the best possible return given your economic circumstances. And finally, it doesn't take into account the cost of capital. So if you have projects with differing capital cost, so let's say you're looking at a hotel and an apartment building, well, the cost for mortgage funds are going to be somewhat different typically because of the nature of risk and return that the financial institutions are going to face when they compare hotels to apartment complexes. And that's not included in the IRR calculation. We have one. Let me at least show it to you. You can play with it periodically and throughout this semester. You don't see it all the time out there in the market, but you should be aware that it exists as a way of actually comparing or putting a sanity check on your IRR estimate. And that is the modified or adjusted IRR. And what it does, it's a formula that includes the financing rate or the cost of funds and the reinvestment rate for the project. So both of those things are at least solved, and it allows you to incorporate the reality that you're not going to hit a home run with every dollar that comes into the building, into your checking account, and that there are cost of funds that vary by project. Let's take a quick look at that example. In essence, I've taken the same numbers that we had in our previous example, so it's 1.5 as the outlay. I'm growing at 3%, as you can see. I'm selling it for 1,770, and then I have the cash flows that we've already calculated in the past. We also already have seen these. There's our IRR, there is the cap rate, and there's the MPV. What you have right here is the modified IRR if I incorporate these two components, a finance rate or a cost of funds of 5%, and a reinvestment rate of 9%, and a reinvestment rate of 5%. In essence, what I'm saying then is I'm going to take this money and I'm going to invest it in a relatively safe investment so that I can ensure that it is available when I'm ready to employ it. So I'm going to only anticipate a return of 5%. Incorporating those new elements into the story, my IRR, as you can see, at 199 has now fallen in the modified realm to the 944. So we've lost about 50 bips. In the reality, that's relatively small. In fact, as an aside, when you deal with IRRs in the real world, because of the reality that the people that you'll interact with know that these spreadsheets that we're putting together are simply estimates based on today's information and projected out 5, 10, or more years, people don't typically pay a great deal of attention to this sort of a variation. 999 versus 944. Those are, in essence, in the market, pretty much the same thing. In the classroom, because of the way that we work with the numbers on such small or incremental scale in terms of the changes, we will consider this to be a difference. Now, I extended that example to say, well, what happens if the reinvestment rate's actually higher than what the project's generating? So the project's generating a 10% IRR, and I said, what happens if the reinvestment's 14%? And you can see what happens to the overall project's IRR. It goes up as one would expect. All right, so now we have our cap rates and we have our internal rate of return. And I'm specifically interested now in extending that story of the internal rate of return to an element of leverage, or what happens to that return when we incorporate leverage, i.e. when we go get a mortgage on the place. As you know, most real estate is purchased with debt. There's lots of reasons why. First one in the bullet is fairly obvious. Oftentimes, the entity or the individual doesn't have sufficient capital to pay all cash. As you're going to find out, you have a real disincentive to do it anyway. Opportunities for diversification. So if I had $1 million in my pocket, I could put $1 million on one property, or I could put $200,000 on 5 and provide some opportunities for diversification that way. And of course, diversification reduces risk, which enhances our return potential. As you're going to see, if I borrow money, I typically will pay less in the mortgage cost than what I can actually earn on the property, or what the property will return. In other words, what the IRR is. So the mortgage cost is typically lower than the IRR. By virtue of that, you're going to see in a little bit that it actually will increase your return, or the return to the equity investors. Another advantage, at least in the United States, is that interest that you pay on debt is tax deductible. So it comes right off the bottom line on reducing your investment tax burden. And then you can also say you own a property for 5 years and you're thinking about owning it for 5 more. You have observed, or you have invested in the place, and lots of value has accrued, so it's worth materially more or significantly more than it was when you bought it at time zero. You could refinance the project, takes cash out, and sometimes in certain instances that cash that you extract out of there can obviously be used for another investment project, but it is also oftentimes tax-free because you're not recognizing your gain on the investment. So there are a lot of benefits. The one that people typically appreciate the most is that you can control a lot of property value with a relatively small investment. So if the total appreciation in the property in its entirety is, say, 10%, and you only owe, or you're only invested 20% in the total deal, then you're benefiting from that 10% return on not only your equity position, but also the debt position, the other 80%. And so that's what this little illustration is all about. I'm going to go through the whole process of showing you the leverage returns with an example in these spreadsheets. Okay, so let's look at it real quick together. Sometimes it helps if you just kind of write this first one down on a sheet of paper so that you can refer back to the original numbers. So the original purchase price is going to be $1 million. I'm going to generate $70,000 per year in our projected NOI, and we're arguing that it's going to stay flat. And I'm asserting that it's because the leases are flat for 5 years. We're going to hold this thing for 60 months or for 5 years. At the end of that 5 years, those leases come due. We're anticipating that rental rates are going to go up, and that the NOI for year 6, when we renegotiate those leases, is going to go up to $90,000. The terminal cap rate is 7.5%. Terminal cap rate is also referred to as the going out cap rate. So in other words, this is the R that we're going to use to figure out what we're actually going to estimate as our receipts when we sell it. We're going to get a loan for $700,000. So the LTV, or the loan to value, then is 70%. $700,000 on our $1 million. The bank's charging us 7% interest. It's a 25-year loan, and we're amortizing it with monthly payments. Here it is just broken down for you. There's the loan amount. There's your and I's equity. So this is how much we've got to put into this project, $300,000. The NOI, as I said, for the first 5 years is going to be $70,000 a year. I've already calculated the debt service. You can confirm that I am correct at $59,369. So the cash flow after debt service then is the $10,631. This is operating cash flows for the 5-year holding period. Again, because we're anticipating the NOI to be static and expenses not to change as well. As I said, the loan to value ratio is 70%, or the LTV. A new measurement, this debt service coverage ratio, used extensively by financial institutions, is your NOI over the debt service. And as you can see, what it's basically saying is, what's the coverage on cash flow relative to the amount of money that I have to pay the bank. So the bank wants to know that you have sufficient cash flows coming in to service their debt, is what it amounts to. And so they calculate this ratio on your projected cash flows whenever you obtain a mortgage and whenever it is renewed as well. As you can see, 70 over 59 gives you a 1.18 debt coverage ratio, or debt service coverage ratio. That is typically considered relatively low by today's standards. It'd be very difficult to get the get the bank to loan you money for anything less than 120, and the vast majority of the loans today have DCRs of 125 or better. But we'll press on with our example. So here it is one more time with that information. The ratios for the first year are right here, and they're new information for us. Same kind of thing that we've seen in the past, just another bit of divisors, okay? Now I'll go through them. So the going in cap rate is based on year one's NOI, of course, and our initial outlay of $1 million. So the going in cap rate is 7%. Remember that the terminal or going out cap rate that we're estimating right now is 7.5%. It is often the case that when you're doing these kind of projections in the real world, your terminal cap rate will be slightly higher than your going in cap rate, largely because of the uncertainty with the future, economic activity. You're projecting, but you don't have any idea, honestly, what 60 months is going to look like or 120 months is going to look like economically. Another item is referred to as the mortgage constant. This is, as you can see, based on the cash flows that the bank is going to receive, or the lender. So they're getting, in that amortized loan, the $59,369 per year in total debt service. Their initial outlay is $700,000. That's how much they're lending us. And their mortgage constant then is the 8.48. So that represents a similar scenario to this cap rate, right? So if you think about it, this is the initial outlay if you were to pay cash. This is the all cash deal NOI that you'd receive. And this is your cap rate, or your R. Well, their R is 8.48. Your individual R, in this case, the equity dividend rate, the RE, is a function of the cash flow that you receive net of your debt service over the amount of your initial investment, which is $300,000. And as you can see, it's 3.54. And what we typically see this as, or refer to it as, is the cash on cash return. You will hear lots of folks in the investment world, you will read lots of articles in real estate and REIT papers on cash returns. As you can see, it's relatively low. I'm getting just under 4% per year on my first year as far as my return goes, whereas the bank's getting 8.48. So on the surface, it doesn't look very good. As I said, investors will focus on this. Their primary concern is IRR, but they're particularly interested on cash returns, and here's the primary reason why. Because it's very difficult sometimes to sell to investors an investment that will generate all of its winnings when it sells. In other words, they will typically want to know that the project can generate some returns and generate some revenue as part of its operating process, not just on the hope that it sells for a large return at the end of the holding period. And this is a good measure of the project's ability to generate operating cash flow and returns that are, profitable to investors. Much like some of the other things that we've seen in the previous slides, especially when I did that segmented cap rate for the land and building, I can use the weighted average cost of capital sort of relationship to calculate the cap rate for the overall project as a function of the mortgage constant and the equity dividend rate, or cash on cash return. That was the 848. There's the 354, and there's the proportion that equity is invested in the property, and there's the proportion that debt's invested in the property. Multiply those out, combine them together, and you get the overall rate of 7% for the project as a whole. It says here, just to give it to you just for a minute, because the cap rate RO is less than the mortgage, so because this 7%, the overall property cap rate is 7%, and because it is less than the mortgage constant, because of the fact that it's a blended relationship, we would anticipate that this guy, the equity dividend rate, would be lower than the cap rate. But from our perspective, does it necessarily mean it's going to be a bad project? As I said before, you would call into question a number so low on your operating cash flow because it would create some uncertainty about the reliance that we're placing on the sale to generate all of our returns. But we'll press on with this as an example, okay? And the main reason why, of course, is because their primary interest, if you're an investor, is the IRR. the return to the equity return, the cash on cash, even though it's important, it's still just a first year measure. Okay? And of course, we want to see what happens during the whole period of ownership, which will include potential increases in property value. There's a change in NOI that I have projected in here at the end of the 5 years because of lease changes. And of course, because it's an amortizing loan right now, we're actually paying on the loan balance and reducing it during the holding period as well. Let's find out what our returns are. So the first thing that we're going to do is we're going to calculate the loan balance after 5 years. By now, you guys should be fairly comfortable with that, but I'm illustrating it here again just in case you need it. If I solve for that present value at the end of 5 years, I have an outstanding balance of the $638,135. So I know that at the end of the year, or at the end of the holding period, when I sell this, that's the initial outlay that I'm going to have to the bank. Of course, there'll be others that we'll incorporate later that are things like selling costs and taxes and so forth. But we'll get to those as we press forward later on. Let's just go with this. So I have to figure out what the selling price is going to be, or at least an estimate of what the selling price is going to be. Keep in mind again that I said in year 6, cash flows are going to be projecting or generating an NOI of $90,000. Remember some little notation that I gave you on the V equals NOI over R relationship, and that is that I calculate the value today based on the cash flows tomorrow. So when I am doing spreadsheet flows with 5 and 10 year hold periods, I have to calculate or forecast the cash flows out an additional year. So why? Well, consider this. So the V that I want is year 5, right? So it's V sub 5. I need NOI sub 6 in order to figure out what that value is worth. And so that's why this is $90,000, because it's our projected NOI for year 6 cash flows. So then the $90,000, and then I gave you the terminal cap rate of 7.5%. So we're planning on selling this thing for $1.2 million. We owe the bank, of course, at the end of that 5-year period, the $638,135 that we just calculated on the previous slide. After we pay that out, our proceeds from selling then are going to be this $562. You and I only have $300,000 in it, so that represents a $262,000 increase in our equity position after we sell. As I get a little note here, assume for now that this is net of selling costs, so we haven't incorporated this yet. We will in a little bit. We'll add some more stuff. Sort of a one step at a time kind of thing. All right, so let's see what our return is, our yield or our IRR. So the equity, again, that we originally put in this thing was the $300,000, and I have that as a minus. Our cash flows for periods 1 through 5 are just under $11,000. That's NOI minus debt service. That's our before-tax cash flow from operations. The $561,685 represents our before-tax cash flow from sale. So I've got operations for each year. I have sale in year 5. And I have a holding period of 5 years. If I solve for I, or you could do this in a calculator, or you could just put it together on the Excel spreadsheet and calculate the IRR that way. Either way, I end up with an I of 16.19. So that's the equity investor's return. Equity investor's yield, equity investor's IRR. If you and I had just paid cash for this thing and not borrowed any money, then the cash flows would have looked something like this. We would have paid out $1 million at time 0. We would have received $70,000 a year in cash flows. No debt, of course, so that's net. Our before-tax cash flow when we sell it then would be all of the proceeds from sale, and that's $1.2 million. And if you solve for the IRR under that scenario, you'll see that your return to the equity investor is 10.26. You can take 10 and a quarter with no leverage, or you can receive 16.19 by going to the bank. You instantly see a nice quick example of the benefits of leverage. Leverage allows you to gain on the entire appreciation of this property and to gain on all of the benefits of cash flows with only having a proportional amount invested, in this case 30% of the value. So the relationship looks a little bit like this. Remember that the interest rate on the loan was 7%. There wasn't anything dramatic or hidden in there like points or anything. So that's what the yield to the bank is. So their Y or yield is 7%. The property's yield or Y sub O is 10.26, and our yield is 16.19. Real benefits from investing. It says here because the IRR before borrowing money is greater than the mortgage interest rate, there is positive leverage causing the IRR for the equity investor to increase. What is that actually telling you? Let's take a look at these two. The YO, the yield to the property, the O stands for overall, by the way. So YO is 10.25. YM is 7%. Remember that the yield to the mortgage and the yield to the equity together represent a blended rate or a weighted average cost of capital opportunity for this guy, the 10.26. Right? So if I take this and multiply it in this case by 0.7 and take this and multiply it by 0.3, I'm going to get 10.26. So what this note's basically telling you is when you let's say you did your projections, you run it out, and you did it unlevered because you wanted to see what the property would do. And you generate 10.25. Now you call the financial institution, and the financial institution interviews you and gives you a number of different questions to answer. And you say, so what are you going to charge me? They're going to charge you 7%. You instantly know, by virtue of those two bits of information, your projected IRR for the property at 10.25 and your estimated interest charge for the debt that you're about to obtain. Because of that relationship, you know that your yield is going to be higher than the property's yield because of the fact that we blend these two together to get the overall. And all I'm doing here is providing a summary of all of those different bits of information. So there's the first year components that we had: cap rate, mortgage constant, and equity dividend rate. Here are those overall rates over the whole period. So this is 1 year R. This is the holding period, the total yield. So there's the YO for the yield to the property, yield to the mortgage, and yield to the equity, just in summary form. And then lastly, I'm going to take these R's and I'm going to take these yield rates. And I'm showing you what happens if there's a certain relationship existing. So just to run through this one together, if RO is less than RM, then you can expect this guy to be lower. RE, the equity, the cash on cash return, to be lower than the overall cap rate. And that's basically what those are saying. Just summarizing. Well, let's shift gears just a little bit and look at the different options you have for borrowing. So up to this point, and for the most part, we'll stick to it. We're going to look at relatively traditional approaches to financing, where you're going to go to the bank or some lender of some nature, and you're going to borrow a proportion of the value, and you're going to incorporate your component in equity, and we're going to look at the returns to those two different positions. But there are other angles, some of which are used extensively in the market. And so let's just outline a few of those. The first one I'm going to talk about is a convertible mortgage. In a convertible mortgage, the lender has the opportunity to convert some or all of an outstanding balance at some specified period of time from debt to equity. Usually, that privilege will afford a discount in the interest rate charged and offer a benefit to the borrower in a reduced cost, and the benefit to the lender and an opportunity to participate in the event that the property value increases. and they are provided an option on that so that if it's not going up, if it doesn't make sense, then they don't take that position. We've already looked at this. This is a ground lease. In this environment, you're going to lease the land for some specified period of time. Typically, like I said in the earlier example, it's like a 9,900-year lease. You're going to develop the property. You're going to own the building. You may even sell the building. And when you sell the building, of course, the accompanying lease will be attached to that transaction. The landowner continues to retain interest in the land. At the end of the lease, there's oftentimes a buyout option for the landowner to make a purchase of the remaining value in the building, or there's an opportunity for the building owner to purchase the land, or the building's residual value is such that it is depreciated so much that the building is torn down and the land is redeveloped. It is often the case that the land that's in these leases is owned by a government or a nonprofit entity. And the reason for this is tax benefits. So one of the things that I used to do before I became a professor as a consultant, I was an advisor to the healthcare industry. And so one of the places that I spent my energy was helping hospitals increase their office space at a relatively low cost. They oftentimes had, and still do today, have relatively large complexes, right, where they have acquired a lot of the land around their main hospital unit, but they don't have enough office space. So what they would do is they would solicit for some practice, say a cardiology or an oncology practice, to come in and build a 2 or 3 story office building, occupy some portion of it, lease out some portion of it, hire a management company to take care of the property, and then pay the hospital a rent to lease the land. The beauty in that was that the hospital would retain control over the land, so future development was still in their hands. From the cardiology practices perspective, the beauty in that was that they could get in without having to pay for land. They were immediately proximate to a strong market. And from a tax perspective, land doesn't depreciate. It just sits on the books at its original value. So if you're a nonprofit hospital, you can hold that land on the books all day long. It doesn't matter. It has no influence because you're not paying taxes. If you're the cardiology practice, you want your assets to be depreciating so that you can take advantage of that tax benefit rather than holding that land on the books. The lease you pay for that land is tax deductible, so it benefits both entities at the end of the day in that example. I'm not going to spend a lot of time on this. It's just a visual illustration of what happens to value as the land lease arrangement continues over a long period of time. We see the building tend to depreciate as you might imagine. Another alternative is the sale and lease back. So the owner of the property might develop it and then sell the building or land only, and then lease that land back. If you lease the land back, we're back to the same scenario where I'm getting a tax break on the lease payments. I'm reducing the burden on the land. I can also cash out that way. So I get a portion of my development costs back in my pocket so that I can go to my next project. And it gives me some flexibility and gives someone else a relatively strong investment, knowing that at the end of the lease, they're going to still have the land or have some option to purchase or have a buyout option from the developer. Either way, they're a winner, and they get to clip the coupon on the lease payments over the course of that lease. Some others, we have the obvious second mortgage, where it's piggybacked on top of the first mortgage. We have a mezzanine debt scenario where the owner's equity in the property is the collateral rather than the property. It's a little bit confusing, but think about it this way. If you're a lender and you take a mezzanine position, what you have to understand is you do not have a claim on the asset. You only have a claim on the cash flows that the asset is going to generate. So that puts you in a much different position. And so as you can imagine, if you're a lender, a mezzanine lender, your interest charges are going to be a bit higher than a more traditional lender that still has a claim to the property in the event that the owner does not pay the payments and defaults on the loan. There's the joint venture arrangement, and we're going to get into those in a great deal more detail. In those scenarios, you're an investor. You run out and find yourself a number of other investors, and they participate much like you do in an equity position, but they're typically more of a silent partner, whereas you're the operating partner. You're going to pay them oftentimes a preferred or guaranteed rate of return, guaranteed in quotes, of course, but it's referred to as a preferred return. And then they also get to share in any of the benefits or growth in value that may accrue to the property over the course of the project. I'll leave it at that. We're going to get into those again in much more detail in the future. The one that I am going to spend a little time on is the participation loan. And from a traditional financial institution perspective, i.e. a BB&T or Bank of America or Citizens and Federal type entity, you won't see participation loans very often. But in other worlds, such as when insurance companies are involved in properties or major pension funds or so forth are participating, you will see such arrangements where there are participation loans as part of the agreement. And the idea behind that is that I'm going to be the mortgager. I'm going to provide loan funds, and I'm going to receive payments on that loan, and I'm also going to have some option to participate in the appreciation and returns to the property from an equity standpoint. In a participation loan, the lender can participate in a lot of different ways. They can take a portion of the annual income, trim some off of the bottom line NOI. They can participate in resale, so they'll not take cash during the operating period, so that way the facility stays solvent, but they'll receive proceeds on the sale at the end of the day, or a combination of both. There's some advantages both to the borrower and the lender. Of course, the lender gets to diversify their portfolio, right? So they're getting maybe fixed rate returns on the mortgage side, and they're taking an option or participating in the option that a property will appreciate. This is a particularly valuable angle to take in markets that are going up, obviously. If you're willing to lend to a particular borrower, then you probably have confidence that they're going to do well or succeed with the property. Otherwise, you wouldn't have made the loan to begin with. So the opportunity to participate in the performance of the property, if it does well, should make some sense. Of course, that's not free to the lender. You typically will see that the interest rate is lower. That'd be the only incentive that a borrower would have to part with their equity position. By lowering the interest rate, you're lowering the debt service during that operating period, which gives you a lot more flexibility. The financial institution will typically also provide you with a higher debt coverage ratio. If they're going to provide a higher debt coverage ratio and lower the interest rates, that will dramatically increase the opportunity or the possibility of making a project actually work financially. Let's go through a couple of examples. So in this first one, we're going to go back to one of the illustrations that we've already seen. And I'm going to say that the lender has offered to participate by taking 25% of any increase in value. So after the 5-year holding period, whatever the change of value is, they're going to take 25% of that. And for that privilege, they're going to lower the interest rate from 7 to 5%. Well, let's see how your IRR is affected by that offer. So first of all, I'll go over here. When you pull up these spreadsheets, one of the things that you'll see is a mortgage run for just for your benefits. I've done the calculations for you and utilized the formulas so that you can see how it plays out. Okay, so there's the interest payment, the principal payment, and there's the running outstanding balance. And this is from that project where the sale price was $1 million at the beginning. We're going to sell it for 1.2. We're borrowing $700,000, and we're putting $300,000 in equity. Okay. So you have the mortgage run right there. Here are the particulars without the participation. As you might recall, the annual mortgage outlay, the debt service, was $59,369. almost $5,000 a month. If we lower the interest rate to 5%, that lowers our payments down to $4,100 and our overall annual debt service down to $49. Okay, so coming over here, so some of these items we've already seen, right? So we know what the NOI is. The NOI is the $70,000. The 5% loan results in a debt service that's $49,106. The residual of that before tax cash flow after debt service is just under $21,000. By the way, note, by virtue of that reduction in the interest rate, our debt service coverage ratio goes up to 143. And of course, from a financial institution standpoint, that starts to make a lot more sense. There's a lot more coverage in this $70,000 when it's responsible for debt service of just under or just over $49,000 rather than the $59,000. Well, as you recall, the financial institution is going to take a portion of any increase in value. And the deal that I set up was 25% of that. So we're buying it for $1 million. We're projected to sell it for 1.2. So for the moment, you're going to assume that it sells for 1.2, okay? We're going to pay off the loan balance. That's the loan balance with the 5% outstanding. You'll find that over there on your mortgage run sheet at month 60. So the total appreciation in value again of $200,000, the financial institution taking 25% of that, so they're taking $50,000. We pay off the loan, pay them the $50,000, and the leftover cash flow on sale then is the $530,000. Let's find out what the IRR is then with the participation option. So we paid the $300,000 out. You and I calculated the before tax cash flow at $21,000 a year, remembering that the leases were static. We get that on the year 5 operating cash flow story, and we also receive the $530. So our year 5 cash flow then is $550. That generates an IRR of just under 18%. As a reminder, the IRR without participation is 16-19, somewhat lower. So in this case, from a borrower's perspective, it makes sense to take this option, largely because the reduction in the interest charge from 7 to 5% is significant, much larger than this $50,000 hit that we're going to take at the end of the deal by allowing the lender to participate in the resale proceeds. Now I got one more that I want to go through with you. A little bit more detail, something a little bit more interesting, I guess, a little more complex. So let's read through it together. I got a property that's going to have an NOI of $90,000 the first year, and it's increasing 2% per year thereafter. It's going to be sold at the end of year 5, so it's another 5-year hold. And the terminal cap rate's 9%. And of course, it's applied to year 6 NOI. This is a new construction project, and it's going to cost us $1 million to build it. The lender is offering a 90% development cost loan with a participation loan at 9% interest rate, interest only, plus 50% of the NOI in excess of 90. Okay, so let's think about that for a minute. So the interest rate's 9%. The LTV they're offering is 90%. So that's a pretty high LTV, obviously. One of the caveats is that they will leave their hands out of any NOI up to $90,000. And after that, they get 50 cents on every dollar that the property generates in operating funds. And they want 25% any price increase at resale over the original. Okay, so then we have some things that we want to find out. What's the unleveraged return? What's the leverage return? And under the context of leverage, I'm going to suggest that we only have this option, this participation loan from an option standpoint. And then what is the lender's return? All right, let's take a look. So calculation of the unlevered return. All right, so it's going to cost us $1 million to build it. We're projecting first year NOI to be $90,000. It's growing at 2%. We're going to hold it for 5 years. Notice I'm going to forecast that NOI out to year 6. And the reason why I'm doing that is because I have to figure out what I'm going to estimate the resale price to be. The resale price, V, at year 5, is a function of NOI in year 6 and R, the cap rate that is given to us. And so it's 1104. So our cash flows, initial outlay, operations, and operations plus resale are in line 9. That generates an IRR to the property of 11%. So that's the unlevered IRR. As you can see, this example's basically summarizing most everything we've gone through in Chapter 9 this far. Okay, so let's take a look at this levered return, remembering the arrangement that the financial institution has offered us. So we still have the $1 million, we still have the $90,000, the 2% increase, projecting through year 6, selling the thing. The loan payment, it was interest only at 9%, so that's $81,000 a year in interest charges. Obviously, it would be monthly. This is our annual outlay. We want to figure out what their take is. So, first of all, from an operations standpoint, they get 50% of every 50 cents on every dollar generated over 90,000. So, as you can see, in year 2, to make life simple, we project $1,800 in increase in NOI over the original 90,000, and so they're taking the $900, and that's what's going on throughout the process. Additionally, they need their cut on the increase in value over the original cost of construction. The original cost of construction was $1 million. The anticipated sale price is 1.1. They get 25% of the increase, or 25% of the 104,081, for a total of 26,020. So each year, the financial institution receives $81,000 from us in interest fees. They receive 50% of every dollar in excess of 90,000 that we generate in operations, and they receive 25% of every dollar increase in resale value from the original construction cost. And for that privilege, they're giving us a 90% LTV loan. I extract all of this out of the deal, and our total cash flow then looks like this. We are going to have to come up with $100,000. This is our before tax cash flow after paying interest and paying the participation piece as it kicks in from an operations standpoint. And this is our net from operations and proceeds from sales. The IRR for this stream of cash flows is 21%, 20.81. That compares to the 11%, almost doubling what the unlevered return would be. So at the moment, the way it's structured, it looks like a pretty good deal. Let's see what happens to the financial institution. Remembering that their loan was for 9%. So they're going to, again, I'm going to go through this quickly since you've already seen it, at least seen the numbers. So they're giving us a loan for $900. They get their interest charges. They receive their portion of the operating returns, and they receive their proceeds from sale. And so their cash flows are right here on an annual basis over the course of the 5-year hold period. Remembering again that their interest charge was 9%. They're actually making, if everything goes as we projected, 9.66%. And that's how a participation loan is structured. Okay, let's take one last look at a summarizing example. The spreadsheet sort of brings a lot of the things that we've talked so far together. about together into one project. I have kept the numbers relatively small so we can kind of focus in on what's going on and not worry about calculating large figures and so forth. So in this example, the project cost, the acquisition, is $100,000. Okay, we're projecting gross income, and in terms of the terminology that we've used so far, this would really be EGI, effective gross income, of $14,000. Okay, our estimated operating expenses, $4,000, so that gives us an NOI of $10,000. All right, so the cash on cash, the RE is $10,000 in NOI and $100,000 for the initial outlay, so 10%. Okay, the financial deal is set up like this. The LTV is going to be 80%, requiring 20% down. The lender is offering a loan as an amortizing loan for 25 years at 5% monthly payments. Over here I've calculated the payment, and it's $467.67 a month. Of course, we're going to multiply that by 12 to get our annual debt service at $56.12. So I start with EGI, I take out expenses, I take out debt service, and I'm left with this line here referred to as net cash flow. In the previous examples, you and I would refer to that as before tax cash flow. Okay, so we have $43.88 before taxes. The leverage return, so the return to the equity position, this being the return to the project, RO. I think I said RE earlier. Sorry about that. RO. This is the RE, or $43.88 over our outlay of $20,000. So the RE is 22%. I just swapped it around, got a cap rate of 10% that we calculated earlier. The NOI is $10,000, and we end up with a value at $100,000. So this is a summary of where we are at this point. We haven't incorporated the tax effects, and so it's really still uncertain what the final benefits are to you, the equity investor. We've just looked at it from the property perspective. And when we come back, we'll start incorporating the tax effects. And then after that, we'll take a look at some of the things that you and I would look at in market analysis if we were going to create these spreadsheets, because they don't occur in isolation or in some kind of a bubble. They're based on our interpretation of what information is available out there in the market that tells us what the market may or may not do in the future, at least to give us some kind of a signal or hints about what's going on. I would encourage you, with this behind you, this Chapter 9 material behind you, to go out there and find a property that you might be interested in and gather some information and knowledge on what the rental market is for a property similar to that. See if you can come up with some forecast for cash flow. Throw in some numbers. If you need some hints on this, send me some emails. Do you want what would the loan look like? I can give you an idea of what interest rates would be today based on the type of property. I probably won't be able to do any better than you at figuring out what rents are, but I can tell you how it would be structured. Give you an idea what you might put down there for vacancy, depending on what the property is and where it's at. The easiest way to learn how to do these is much like anything else that we tend to learn. It's by getting in there, getting your hands dirty and doing it. Put a spreadsheet together. Find a piece of property you like. See if you can come up with something that tells you that the thing can or can't make money. And we'll come back together and add the tax components. Bye for now.